to the Professional Investment Podcast. I'm Charlotte Moore, award-winning journalist and co-founder of Moore Squared Communications. Each episode, we welcome a guest to the show to share their news story of the week. And I'm delighted to welcome Sofia Perkonigg, UBS UK Pension Fund. She's the trustee director there. Welcome to the show, Sofia.
Thank you very much for having me, Charlotte. It's great to be on the show.
And do tell us, Sofia, what is your news story of the week?
So my news story of the week is 17 pension providers signed the Mansion House Accord. It's been published on the professional pensions and it was on the 13th of May 2025. The key points of the article are really around the largest DC providers having signed an accord committing to invest at least 10% of their default into private assets, with a minimum level of 5% invested in UK assets.
Yeah, so it's a fairly big news story, but do tell us, what do you think the significance of this is?
Well, I think that's an exciting development and a very positive step in the right direction. I think, in my opinion, there's also really some three elements that make this probably likely to be a success in my view. One, I think there's an alignment of interests between the various parties here. So the pension providers, the government, and the broader pensions industry. Two, I like the fact that there is a commitment with a clear goal, but also clear asks of the government to support that outcome. And third, I think it's a pragmatic timeline. So 2030 seems an achievable goal for that objectives. And the fact that we have 17 of the largest providers that are coming in and committing to this means that not only will that be a significant impact, but in reality, when you have such a big proportion of the providers committing to this, in reality, it brings the whole market with them. So the effect of the accord is likely to be amplified, and I think that's a good thing.
Yes, and so, I mean, this is something we've obviously been talking about across quite a few episodes of the Professional Investment Podcast, and it's been something that's rumbling around in the background ever since we had the first Mansion House Compact. What do you think are the challenges and opportunities for pension schemes when it comes to private assets?
Well, again, in my personal view, that doesn't represent the UBS fund per se, but I do think actually that there's some great opportunities here that we need to take advantage of. The first one is this would likely boost returns for pension pots, and I think that's essentially what the article also refers to, and one of the stated goals of the accord. Two, I do value the level of diversification this will allow us as trustees, as managers of pension funds within the DC space. I think it broadens the toolkit that is available to us to also use the right types of assets at the right time in terms of market cycles and deliver better outcome for members. So diversification is a big positive in my view. I think also investing at such a scale helps also with negotiating better terms for management fees, for example, for private assets. I think private assets haven't historically been a cheap asset to invest in. And I think, again, the scale and the element of predictability might allow us to get better terms also for members. So a lot of positives in my view. I think there is also clearly an element with regards to how supportive of the UK economy this is. And I think this is perhaps one of the longer term aspects of and benefits that we will see here. Most of the UK pension funds members today are very likely to retire in the UK. So having a growing, thriving economy that's going to support funding to infrastructure, to essential services, even things like the NHS, means that this is a positive environment for members to retire into, and also potentially, a good sign for longevity extension in the future. So I think it's a good way for us to hit a number of positive elements in one go through this implementation. Now, there are challenges, and I think those are important to also acknowledge. A few of them are outlined in the article, but one that I find particularly interesting and important, and probably a condition of success here, is really around the government's ability to facilitate a sufficient pipeline of assets, especially for the UK part, generated and basically originating sufficient number of deals that we can invest as DC pensions in a way that is not only reasonable, but also selective. So the last thing we want is really having a large growing pot of money chasing a small number of assets. If anything, that actually would destroy value for members, and it's not the outcome we're hoping for. So if we manage to do that and to execute on that well, I think we would be off to a great start.
Yeah, and I think that's a really good context, because there is this feeling of like being pushed into something is never a good idea. If you're a forced buyer of something, you either buy the wrong thing or it gets pushed to the wrong price. And there are questions, aren't there, about why the UK, why are we doing this now? Some of the most common criticism I see is, if this was such a great idea, surely pension schemes would have done this before. But I think it's important to have a bit of context about why the UK pension schemes haven't done this before, because investment into private assets has been happening in other highly developed pension schemes around the world, whether that's Canada, Australia, or the US. And there is a structural issue here, isn't there? We had DB schemes that were under very tight constraints about how they should invest due to the way their liabilities are valued. And then we've had also, just DC is still nascent, and that's why there's so much change at the moment, is because DC is really becoming big enough to be able to start doing these things, and the same with the LGPS. So there is a market structure argument for why now is a good time to do it, along with the UK government obviously wanting to find extra investment for the economy. So are there other factors other than those ones I've outlined which have held us back?
Yeah, there were, and I think a few of them have been addressed, but let me just talk you through what to those perhaps. The first one is in the DC space. Illiquidity has been historically a difficult feature to manage from an operational standpoint with regards to the platform and the administrators. So they were not necessarily ready or prepared to support that, which made it very difficult from a pragmatic perspective to implement, even if you had decided to implement to allocate a little bit more to real assets in a DC construct. So I think that is something that's changing, and I think it's going to be a very important element of the members' experience throughout this transition. Two, I think we obviously real assets have fee structures that are different from the ones that we're used to in daily dealing funds. We're not looking at flat fees here. We're looking at a performance fee that is added to the end. And that has historically been also something that just didn't fit well within the flat fee structure of DC. And if we add to that the fee cap at 75 bips, 75 bips is a reasonable number, but with regards to allocating more to real assets, then you might hit that cap fairly quickly, especially again with that element of performance fee playing out. So I think those three pieces have been holding us back a little bit in terms of investing in real assets. But I think a number of those limitations have or are being addressed with new vehicles, new structures, and actually new rules as well. So I think we have now a good basis to progress in that direction of hitting those 10% allocation to real assets. I would touch though on the point you were mentioning also, Charlotte, with regard to DB. And I think what's interesting is, yes, in the UK, DB has been managed more conservatively, and the fact that we've seen funding levels go up is definitely, it goes in one way with regards to de-risking. So, and the real assets are probably not part of that equation, to be fair. But I think the fact that we have a history of DB having invested in private markets means that there are a number of trustees out there and their advisor who have experience with private assets, and therefore the learning curve is perhaps less steep than we think. So, and I think that potentially is a favorable element to consider.
So, I mean, I think we've kind of outlined the why we should do this, and we're beginning to touch on the how. You mentioned LTAFs there. So let's talk about how DC funds might go about this, because there are different approaches, and the government obviously designed the LTAF to facilitate this investment into private assets by DC schemes. Are LTAFs the way to go?
I think LTAFs are definitely a way to go, and a very interesting one, and clearly one that, in my view, will facilitate access to private markets to some of the medium to smaller size pension funds. I think we can touch a little bit more on that, but I also think there are other ways to access private markets, and we can see, for example, that the largest master trusts had publicly communicated around the fact that they've decided to go direct in terms of investing directly in the underlying funds. And I think that's a great position to be in if you can execute on it. And usually that depends also on, how much liquidity you have in terms of inflows that allow you to manage that illiquidity challenge in a different manner than the one that is perhaps scripted within the LTAF construct. So I think it's a direct investment is one that I find personally very interesting when you have the right scale to implement it. I think that's definitely a very attractive approach. But LTAFs probably are the easiest and the stepping stone that we'll see a number of pension funds adopt in the future. And also we're seeing quite a bit of supply now in terms of new funds being launched by different asset managers, different providers, be they single assets or multi-assets, and be they also managed by one single asset manager or by being an aggregation of multiple of funds from multiple asset managers. So I think the more choices we have, the more trustees and their advisor will be empowered to make the right selections for their members.
Yeah, so I think that, let's get into that, because there's all kinds of interesting questions there about, should you be choosing one LTAF for every asset class? So let's just break it down a bit more. If we're talking about private assets, we're typically talking about 4 different asset classes, aren't we? Real estate, infrastructure, private debt, private equity. And obviously you can have private debt and private equity classifications for both real estate and infrastructure within that. So of those kind of 4 broad asset classes, are some more appealing than others, or does that depend on where you are in the member's journey when you're talking about DC? How are you thinking about those 4 different asset classes and which ones might appeal? And then we've also got things, haven't we, like private equity seems to be going through a bit of a difficult time at the moment, where we've had a lot of people who are finding it very difficult to exit and make the profit on their investments. Lots of challenges around that, lots of question marks about whether it's a good time to invest in that asset class right now. So, I mean, timing is everything at the end of the day, isn't it? Something can be incredibly look like a great investment, but if it's not at the right price, then you shouldn't be investing.
I think what I like about having access to the variety of investments and asset classes we're talking about, the ones you mentioned, real estate, infrastructure, PE, and others, private debt, and also all of those in their debt and equity incarnations. I think what I really like about it is really having access to those tools and being able to use the right thing for the right moment and the right challenge that you're trying to deal with. And you're right that actually where we are in the members' journey is a big driver of that. And I'll share a few examples, but I think there are actually perhaps 3 elements that influence what you use, really. The first one is, as you said, where we are in the market cycle and also how dear those assets are. Is it a right entry point really at the moment for PE, among other things? And we are in a very uncertain environment. So to some degree, again, diversification is there to help us out in that kind of context. So being able to leverage that is a benefit. 2, I think, as you described, it's the retirement date or the target retirement date for each of the default sub-funds that we'd be looking at. And the third one is really how conversant and comfortable are the trustees and their advisors into each asset classes, because we'll have a bias there as well. So if I start with the last one, I think what we typically see in terms of the adoption journey of real assets is really first foray for DC pensions would be in real estate, debt or equity. Then once they're comfortable with that and with the asset managers, the process and the illiquidity piece, that graduate into, say, infrastructure, maybe debt or equity, and then go on to private equity with regards to the sophistication levels and the comfort levels. So I think that's actually also driving some of the choices that we might see, especially in the early stages of the allocations. But you are very much right that in theory, really, one of the key drivers is where we are in terms of the timeline and the target retirement dates for members. And there I would actually differentiate between two pieces: the defaults that are targeted an annuity, which is what we've been doing most of over the last few years. And there you really have that element where in the early years you want to drive growth, you are able to take more risk because you have more time to recover from it. And in that case, PE, VC, those kind of like more higher returns and higher risk asset classes have a role to play. And then actually, I think as you get closer to the middle stage of that retirement journey, maybe you'd start looking at infrastructure. And from the equity standpoint, I think infrastructure has some interesting characteristics with regards to still having a component of capital growth, but enough income generation that some of those target returns have a bit of a cushion to them. So a little bit more predictability. And then as you get closer to the retirement date, then, debt and private debt could be a more interesting tool to use. But again, if you are targeting an annuity, then as you get close to that retirement date, you have to go more closely to fixed income, because ultimately the goal there is really to protect that investment pot that a member can then take to an annuity provider and have some certainty around what they can secure in terms of annuity. But for drawdown, I think that's what's very exciting at the moment. This is where it's new, but it's also, I think, increasingly an area where we would have to think a little bit more about how we manage that transition from the accumulation phase to the drawdown phase. And perhaps instead of going fully on de-risking, then we can actually afford to maintain a proportion of those assets invested a bit longer, say in private debt, for example, because realistically a portion of that drawdown pot will probably not be accessed for another 10 or 15 years by members who are looking, to hopefully live in their 80s. So I think that's the kind of thinking that's going to drive that allocation. And again, the beauty here is that we have more tools really to deliver on member outcomes, with those various asset classes being added to the menu.
Yeah, so the other kind of big trend in the moment in the industry is people are really starting to look seriously at that. They call it decumulation, which is such a terrible phrase. So let's call it, basically providing an income for people at retirement. That's what it is. When, with freedom and choice, and with no compulsion to buy an annuity, the industry is really trying to develop the best possible design of type of vehicle that could provide that kind of that retirement income. And so I think you're right. There is going to be not just how do we use these assets to help people to really grow their wealth during their working years, but how do we use these assets to help people protect their wealth and provide income during retirement? That's going to be a really interesting debate, and it's going to be really interesting to see how that shakes out over the next few years as we start to see maybe some of the designs of those retirement income funds come to market. And I wonder, taking us back to LTAFs, bringing that idea back in again, because as you mentioned, you could have an LTAF that covered every single asset class, but as you just outlined, it might be that you want different asset classes at different points of the member's journey. So is your feeling that, that pension providers like you should be going out into the market and looking for the best individual LTAF in each asset class, or is there a place for a multi-asset LTAF as well? Because the question is, can you find a manager who can manage all those quite specialist different private asset classes equally well?
I think that's an excellent point you're making there, Charlotte. And from my perspective, I think we should adopt the same approach we've adopted with public markets, which is where you can, where your scale allows you to do so, to go to directly to individual asset classes and providers and be very selective there. So I think that's I think perhaps one of the privilege of size and scale that allows you to do that. And in my view, that would be my preferred option when it comes to LTAFs or direct investment. But I do also have to take into account when I talk to other trustee colleagues who are managing, pension funds of different sizes and different scales, then we, having the option to come into something that has already been pre-designed, pre-thought. Although I have a preference for LTAFs that have multiple asset managers underlying them, because I do think that way offers you the opportunity to make sure that they've selected well-performing managers coming into that. I think that's important. But I think that will definitely can deliver for smaller pension funds. I'm perhaps less of a fan of multiple very specialist, very, as you said, specific asset classes being managed by one group. I think maybe that's something I can be. Maybe it's an a priori, but one that for now I think is what I think more reasonable.
Yeah. So you would prefer to select an individual manager for each asset class, even if you decided that the best thing for your pension scheme was to use the LTAF structure. I mean, it does. Go on. Sorry.
So I was going to say, I think there are LTAF structures out there that are more open, have a more open architecture. And I think perhaps that would be the first place I would personally look. But it doesn't mean that others would be, that it wouldn't be an option. It's just that perhaps I have a slight bias to that.
Yes. Perhaps one other issue we can touch on now. I think that's a really good background into kind of the things that you as a trustee director are considering about as you think about a private asset allocation and what role it's going to play for your scheme members at different points of their journey. One of the things that sort of, I don't know if you were at the PLSA, but one of the things that Torsten Bell alluded to in that speech he gave that opened the conference back in March in Edinburgh was that the government is very keen for pension schemes to find the best investment returns that they can, obviously with the understanding there is a relationship between return and risk, because that does help the government get out of another hole, which is everybody in the industry. The biggest open secret is we all know that contribution levels in DC pensions are too low. 8% is not really what you need to save enough for retirement. But there is a reluctance amongst different governments, successive governments, and obviously within the Labour Party to boost contribution levels given the cost of living crisis. Are we going to have to? I mean, investment is great and you can obviously get more bang for your buck. But as everybody knows, the higher the return, the greater the risk. And there becomes a sort of a question mark about how risky you're prepared to be. Are we going to have to tackle this question of contribution levels sooner or later?
Absolutely, I think we have to. And I think the sooner, the better would be my preference, Charlotte. Now, that being said, I'm also mindful that we are going through a difficult time for a number of members. They are dealing with the cost of living crisis, the housing crisis, obviously for employers, national insurance contribution has just been raised recently. So it is, of course, not an easy time to have that conversation around raising contributions, but there probably won't be a good time to do it. So the sooner, the better. And I think this is critical because when we talk about performance and providing appropriate pension pots for members, then we have really three levers that we can use. One is increasing contributions. Two is basically the time invested. And the third is the one that the Accords are basically targeting, which is investment performance and offering more asset classes that can boost that return. But the future is coming faster than we think. And it's I think, going to become more common to see situations where pensions are not sufficient to support retirees. Actually, just the other day, I went to an airport and helping an elderly relative get through their traveling experience, and I couldn't help but notice while there that there was another elderly woman who was actually interviewing for a job to help those passengers with their luggage and getting them through security and passport control. Now, don't get me wrong, I'm absolutely in favor of people choosing to retire later if they want to, or even decided to come out of retirement to pursue a job or volunteer or do something that they do care about. But I would really like that to be an option rather than a necessity for them. And I think that is why it's having that contribution discussion earlier is very important. And I think you made the point around, Canada and Australia and their contribution levels. Yes, I mean, their contribution levels as of this year are about 50% higher than ours. So there is a reason why they've set up those levels. And I think really that's perhaps the levels we want to converge towards as soon as we can.
Now, this is a point that's been made before on this show. Paul Kitson made it as well in a recent podcast. Mm-hmm. And many people have said to me over the years, it's all very well having people saying that people should work later, but there has to be the jobs for those people and there have to be the jobs for those people that they can do. It's unrealistic to expect a 70-year-old woman to sort of shift suitcases in an airport, for example. To end our discussion, I think we should go back to the beginning. If we think about our news story of the week, what do you hope will be the emphasis of this focus on private assets? If you and I were to talk again in 5 years' time, podcast will be going for that long, of course.
Very successfully, I'm sure.
Thank you very much. Where would you hope that we would be? Where would pension schemes be, and where would we be in this debate on private asset investing for DC schemes?
Well, since we're talking about 5 years from now, that would be 2030, which is the goal of the Accord. So hopefully we'll be invested at a minimum of 10% in private markets and 5% into the UK assets. So basically seeing the Accords be a success story. I think that would be really my hope. With regards to the broader point you were making with regards on private assets and where they would sit, I'm hoping to see them become a lot more mainstream. And I think that is particularly important because familiarity breeds more investments. So more trustees being familiar with them will generate perhaps, a push towards even higher allocations where and when it is relevant and assuming, we take the right amount of risks. But I think that would be one thing I think we will see. One other piece, I know we like to talk more about value rather than cost these days, but I do hope also to see that the fees that apply to those assets are also, thanks to scale, thanks to better negotiations, also on behalf of members, that we get better terms for those. I think it's a realistic thing to hope for with not only scale but the regularity of contributions coming in. I think that's also favorable to managers, so something hopefully we can make work. And I think overall, what I would really like to see, Charlotte, would be actually signs that the Accords are working, that the investment into the UK economy is driving growth, and perhaps even seeing some of the early signs of that in terms of improved valuations in pension pots. So that would be my very hopeful view of the next 5 years.
Okay, well, I think that's a great place for us to end this episode of the Professional Investment Podcast. Thank you, Sofia, for your excellent insights. And I have to say, for being the first person who's managed to colour coordinate their jacket with the colours of the Professional Investment Podcast. I've been admiring how your blue jacket blends into our blue banner at the bottom all podcast. So it's been great having you on the show. And for all future guests, we expect you to be just as well colour coordinated. Listeners, I hope you enjoyed this edition of the Professional Investment Podcast. Do make sure you hit the subscribe button so you never miss a future episode of the show. And please do comment and engage. Thank you for listening.